The information contained in this podcast is an expression of opinion and does not constitute investment advice. This is the Gold Money Podcast with Alistair McLeod, keeping you up to date with expert opinion on precious metals and the markets.
If you back gold to the system, it's probably the least disruptive method in terms of social unrest. Because I think actually most people won't be affected in a negative way if you do that.
Yeah.
Whereas as it stands, if you continue to deficit finance, you're going to get hyperinflation in one country, I would argue, like Japan. These people that say that, well, eventually rates will back up and that will choke off the economy. Well, no, the reason rates are going up is because it's an akin to hyperinflation because people are actually getting out of JGBs.
Yeah.
That's putting more currency into circulation within the banking system, and bank reserves could absolutely balloon in Japan. So,
yes,
it's a fiscal phenomenon.
Yeah, I know you've been very concerned about the outlook for Japan, and I note that I think it was overnight we had the announcement of the largest trade deficit since the war. The situation there, very briefly, I think is deteriorating quite rapidly. Would you agree with that? Yeah,
I mean, I think this is the tipping point, really, and I'm surprised they didn't move faster, was a tsunami. Because up until that point, you actually had a current account surplus in Japan. Obviously, they've got very high gross debts in terms of their sovereign debt, or the public debt is very high. They do have their net percentage of net debt of percentage of GDP is about 130, but their gross is 250. The reason being is they have a lot of overseas assets, but the tsunami was really the critical moment where you've knocked out the power infrastructure, which they have now, they've unilaterally decided that, of course, they're not going to have nuclear power. So they're having to import LNG. I think that the cost component of that clearly has, and the collapse, I say the collapse, there was a bounce back, but essentially it's petered off again, growth in Japan.
Yeah.
Has left this huge deficit. So what does that mean? That deficit means that, of course, now they have to find even more funding at a time where their government finances are irreparable in terms of who is going to fund them. Is it going to be foreigners who earn only 5%? Well, no, other countries got their own problems. Actually, JGB futures are owned by foreigners to the tune of 30%. So who's left to buy? Well, you've got a dissaving economy in terms of you've got an aging economy. So actually, in terms of pension houses are actually selling JGBs because they're having to meet their liabilities, which is annuities for retired individuals. Yeah. So who's left to buy?
Well,
the Bank of Japan.
Yeah, I think that's and that's where they're going. Talking about currencies which are under pressure, which the yen is at the moment. Sterling has taken a toss over the last few weeks. Do you think that the potential changes in the way the Bank of England manages its monetary affairs, do you think this is a contributory factor, or are there other factors?
Yes, no, I think it's a perfect storm, really. I think that perversely the initial sell-off that we saw, particularly in gilts, and to a lesser extent in sterling, and sterling's real effective exchange rate has moved quite considerably. A lot of people will just look at sterling versus dollars, or i.e. cable, but when you actually look at the real effective exchange rate, it's started to move quite sharply lower, as you've pointed out. So I think it's a combination of factors. Rates started moving up because there was a sense of, I think it may be two factors. There was a sense of, things, known crises that could happen were seemingly being dealt with. For instance, Europe overnight seemed like it had reached a level of equilibrium where it was being backstopped, come what may, by the rest of by the ECB. Yeah. Growth had managed to stabilize. I think that the US situation in terms of fiscal cliff there seemed to be some resolution, although obviously they've just ripped up the rule book and the sequestration is going to happen on the 1st of March, i.e. 1.2 trillion in cuts. Yeah. It's going to disappear. 4% of GDP is going to come out. Then, so despite this momentary pause, I think people felt, there's a whiff of growth. Things are a bit better. The periphery looks better in Europe. Rates backed up because there'd been a safe haven trade particularly into bunds and gilts.
Yes.
So I think that was the first initial trigger. And since then, you've had this Carney. So I call him the devil incarnate. I mean, he's come out and whispered nicely in the markets here, and in that we're going to allow prices to rise for an extended period of time. Yes. And that's obviously not good for gilt. So if you look at something like five-year break-evens, i.e. inflation expectations have gone up. 2s10s curve has steepened quite dramatically. Not a lot of hedge funds have had that trade on. It's been difficult for them to make money because there's a negative carry component. But the 10-year yields have backed up to reflect this inflation expectation. Yeah. So I think that has been part of it. And also, actually, the data, the retail sales data, the components of growth outlook suddenly look horrendous.
Yes.
And notwithstanding the autumn budget that clearly was so far off their targets. I'm surprised it hasn't happened sooner.
No, and I can't let you go without asking how you see gold. I mean, as I speak, gold has been hit in the futures markets quite hard. It's actually trading at the moment at 1589. How do you see gold in the short term, Ben?
Yeah, I mean, it's been very disappointing for holders of hopefully holders of physical bullion,
yes,
or our fund, which is an equivalent to physical bullion. It's been very disappointing in light of these inflationary expectations and really the ramping up of balance sheets. I mean, I will say that total credit is around 55 trillion and is being held up at those levels. So we're not actually seeing credit contract, and I would argue that the shadow banking system is starting to grow again. So I do think that the observance of these increases in monetary and liquidity indicators will lead to gold going back up. Now, the question is, why has it come off in the first place? Because ostensibly, it's as simple as this. If you keep increasing the money supply, gold is just the reciprocal of money.
Yes.
So it's that mathematical singularity, 1 over X. You keep increasing the money supply, the gold price will go up. And gold backs the money supply, the monetary base just in the US. And I'm not even mentioning total credit here, which I think is more relevant. It backs it only to the tune of about 15%, arguably less now.
Yeah.
Now, that's about as low as it's been since 1970, since the start of this fiat currency. Now, there is no doubt in my mind the physical market is pretty tight. And what I mean by that is that if you want to get hold of inventory very quickly, reasonably large sums of bullion, you may have to wait a few weeks.
Yeah.
And typically, when you start seeing that, it's not long before the market bottoms out and starts rising. And I would say this recent sell-off I think it's less bullion bank led. I think it's been more about hedge funds and managed CTA accounts responding to 5 or 6 institutional pieces that have been knocking gold. And the reason why I cannot respect these articles or these pieces is because these were people who never understood why it went up in the first place. So all the reasoning they give for why it's going down, which, by the way, doesn't include acknowledgement of what gold is in relationship to money.
Yes.
I can't really give any credence, but the market has wanted to run with it because there's this belief that, equities are rising, there's got to be growth in the economy, gold's over as a safe haven. Gold, yes, there is an element of people in buying safe haven, but the true test will come when gold starts rising along with everything else. Because if you think about it, if they're targeting nominal GDP, then everything will go up in nominal terms. And gold is looking really, really quite attractive in nominal terms.
Yes, I think that's right. I mean, my
and in real terms, obviously.
Yeah, of course. The work I have done fully confirms what you've just expressed. And in the short term, I'm interested to see that in the paper market, in the futures market in America, the outstanding contracts have actually been rising on these recent falls. In other words,
the shorts have got bigger.
Well, yes. I mean, it's the shorts amongst the commercials have got bigger, or alternatively, they have persuaded, as you suggested, hedge funds to sell short, and they have taken those contracts as purchases. So I think it's all about the commercials trying to close down their position. But what one would normally expect, I think, and tell me if I'm wrong, is that as the price declines, you would expect to see a contraction in the overall amount of paper in the market. But it's now going the other way. It's showing that there is actually some pretty big support coming in from these levels. Yeah,
I mean, I think that it's an interesting thought process, and we, as you know, I definitely recognise and understand and believe, and I've been very vocal along with you chaps at Gold Money and along with GATA, that the evidence is overwhelming, not only in factual, but actually what I've seen played out in marketplaces over the last, just even over the last 5 years, that clearly there is intervention in this marketplace. And absolutely there will be, because it really is the canary in the proverbial gold mine. And excuse my poor
yes.
pun, and I've probably said it more times than I should over the years. But it's not in the interest of central bankers or policymakers to have gold rising, because it's pretty evident that the system is debasing very quickly.
Yeah.
And yet again, I find it extraordinary how these institutions will put out very bearish pieces on something like gold. It really does create that love or hate Marmite situation. You never see someone say, oil, it's going to zero.
Yes.
It just doesn't happen. So you sort of, I actually think some of the institutional pieces that were sent out, perhaps less Machiavellian, is just bloody stupid, if I may say that. In terms of the actual positioning in the market, I think I'm very excited by the short base that's appearing in the paper market, because I think the last time we saw this was back in 2005, and the market went up probably 50%. So I think we're coming to a very interesting dynamic. I mean, one point that we don't mention here, and my work partner has been very, very vocal about this. Probably quite a few mining guys probably don't like him, but he's been spot on for nearly 18 months. He was, to my mind, probably the most intellectually honest, and said, we've got a real problem with the mining industry. Costs are being understated, total all-in costs. And he was the first to really say, hey, you know what, I think they're nearer $1,500, $1,600. And what that means in terms of the market, from my mind, is that we've reached this, as they've talked about it being a production cliff, and I think that's spot on. It's like a peak gold scenario. I believe that these guys, the only way they can grow, these guys being the big caps and the mid caps, the only way they can grow reserves now, realistically, is to get involved in M&A. And it's getting harder and harder to get grade and these assets out the ground. And what does this mean? If you can't produce at 1,600, 1,500, what are you going to do? You're going to put your mines on ice. I don't think you're going to see people start hedging, which is what happened at the start of the decade. I think that's not the situation.
Yes, that's over, I think, isn't it?
Yeah, I think they know they're gone and out of business if that happens, because the capex and sustainable capex is just too great. So I think this creates an interesting underpin and floor. Now, don't get me wrong, you might overshoot or undershoot to the downside in the interim. It seems to me, it amazes me how many paper contracts come into the market, whereas I'm not aware of any real physical selling. That's not what's going on. There's a big dynamic here, and it is China and Russia are buying up on their official accounts large amounts of physical bullion, and we all know why that is. It's the gold war. It's equivalent of the Cold War. They're going to back their currencies to gold, or they certainly want that choice.
Yeah. Absolutely, and and letting their citizens, particularly, notably in the case of China, reluctantly in India, also build up their wealth in gold. It's more or less taking out substantially the global production, because production from the Asian countries basically isn't coming on the market at all. So what we've got left in the West is something like 2,000 tons, I suppose. And the bulk of that is accounted for by, private citizens' demand in China and India.
Yeah, I mean, and just to add to that point is that any production in China stays within China, whether it's Western or domestic companies working there. Yeah. And that's happened ever since I've been sort of the last 10 years. So, yeah, there's no doubt they've been accumulating as quick as they can. I mean, it's no coincidence that the market went down when we had the China New Year and everyone was off for the week out there in Asia. So, now let's see if they're going to come back to the market. Obviously, they're probably quite delighted the market's down. So, and this gives them an opportunity to continue to accumulate. Now, the question is, what drives gold to much higher nominal prices? Well, I think that if you continue to try and expand the money supply and the monetary base to circumvent the collapse in credit, eventually will overwhelm this sort of paper sale. But actually, someone asked me a very good question, and you know what? I actually don't have the answer for it, but it's show my ignorance. But why is no one going on to Comex and taking full delivery?
That's a very good question. I don't know the answer, other than to say that given the MF Global thing and all the rest of it, I think that the real money is probably slightly frightened of using Comex for anything other than just punting. But I don't know.
Yeah, well, one thing is for sure that the government, should there be a failure on Comex, the government will settle in cash. The head of the CME said as much actually in a roundtable discussion about 4 years ago. It was Opeletsk, is in Texas, and I think Carl Bass actually asked him the question, and I saw this report, and to my mind, it's certainly something that I particularly wouldn't want to get involved in, because I know I'll probably have the authorities coming knocking on my door and shutting me down pretty quickly.
Yes. Well,
I think that there's probably better ways to deal with it.
I think that's right. We all remember the farce over the Hunt brothers all those years ago in the silver market. And I think, I don't know whether it existed at the time, but certainly now there are force majeure rules written into the Comex's own rules. So you could find that quite easily that if you're standing to take delivery, that the market, perhaps being prodded by people who they have a greater vested interest in than they have in you, i.e. the large bullion banks, might say, sorry, chum, but you're going to have to take cash settlement. But having said that, if that happened, I think it would send alarm signals about the state of the paper market. Almost, I mean, people would just wake up and say, hold on, what the hell's going on here? So that would probably be very, very good for the gold price, I would have thought.
I think within the financial sector, there would be a very acute understanding. I certainly think physical would trade at a significant premium, which is why you have to be anyone who uses Comex futures to speculate being long in the market. I think that's a dangerous game. I mean, it's just, to my mind, it's very easy to own the physical quite cheaply.
Yes.
Obviously, people do it for the leverage, but they've got away with it so far. So I'm sure they'll continue to do that. As you say, I think probably the reality is it will go up when a vested interest wants it to go up, and it might well not be a covering of positions.
That's quite possible. I think the other wild card in all this, I see two wild cards really. I think there's a big wild card in silver where there is less liquidity and a very, very large short position. And I think that could be problematical. The other wild card I see is round two of the banking crisis, which can be on us at any moment.
How do you think that would come about, the banking crisis, the second wave, in your opinion?
Well, the obvious weak point is Europe. And Europe, I think, is disintegrating at a faster rate than we generally realise. And just because it's gone out of the news doesn't mean to say that, the bills don't need to be paid anymore. And, and all the other mundane things that drive governments to despair. I mean, the situation is getting awful there.
Yeah, there's an argument that you can say that they've certainly got their cyclical fiscal problem under control. It's obviously not their structural. You can see that, was it the IMF today? I think it was the IMF today said that give Spain more leeway on their fiscal retraction. You could argue things to some extent on paper, certainly obfuscation of stats, etc., have looked a bit better. The only problem I slightly have with a banking crisis is, as it stands, these central banks have, I think, any correction in the marketplace. So let's say that's the first sign that we see a manifestation of, say, a bank starting to go down, rather like we had with Monte dei Paschi in Italy recently. If this "whatever it takes" comment from Draghi is perhaps the nominal side of the equation is covered by just effectively too much money being made available in a guise that the market is still happy to accept until such point that it's bleedingly obvious that it's actually a problem for prices. I think the what no one talks about is, can price and goods services go up? Can real wages rise?
Yeah.
And I think that, bear in mind that the effect of globalization and this 1 billion of cheap labor is now starting to unwind, i.e. in China, real wages are rising rapidly.
Yes.
Because it's a part of the 5-year plan. They realize that perversely how they want to offset inflation issues is just to put fuel to the fire and just raise their wages. Now, as we know, that reduction, which must have been a sort of 9% reduction in the marginal cost of labour, has really, to my mind, been the only reason why we didn't get very high inflation from all this credit creation in the first place.
Yeah,
so
I think it's I think
that's where it's going to hit us.
I would say there are two things. I think firstly, that is certainly true, but secondly, it comes back to where we started. When the central banks print money to try and sort of keep the system going, as it were, it ends up being speculated within capital markets rather than going into the real economy. In terms of government spending, it goes into the real economy, but it's always going into, sort of welfare, and so it supports those particular industries like, the health sector, education, and so on. But otherwise, I think prices probably are rising more rapidly than we think. When I look at the CPI in this country, which is something like 3%, the way I see prices rise, they're rising considerably faster than 3% with my own personal spending. So either the statistics are wrong, or if they're right, there's a parallel universe with someone opposite me finding that he's got a deflation effect on his prices. So
that makes me think of Schrodinger's cat.
Yes, a bit like that.
Universe.
Yes, exactly.
Yeah, I definitely agree with that. My work partner was just lamenting the cost of utility bills, which perhaps you might not hear from a hedge fund manager who probably has been overpaid more than he probably deserves. But when you look at how much that makes up cost of living from utility bills, and if you don't own your house, from rent, from taxes, in terms of housing taxes like council taxes in the UK, you begin to realise that outside of food, that's getting pretty close to 50-60% there. And I can tell you that's definitely running at 7 or 8%.
Oh, yes.
So you start doing the maths and you realise, look, there's no doubt that there's been a mass manipulation, distortion that started in CPIs going back to the Boskin ruling in 1996 when they introduced hedonistic pricing substitution effect. I mean that's a given in my opinion, but obviously it's this whole erosion in cost of living has happened at such a slow rate that it's no coincidence. I think I get in the back of a taxi, that old cliche, where about every 4 years the taxi driver turns to me and goes, "Oh bloody hell, cost of living's really really high." Because so if they put a surge of inflation into the system now, you don't really notice it for a couple of years, and then suddenly in the third or fourth year you go, "Wow, things really do cost a lot more." Now there's an end game, because at some point you can't control that dynamic and expectations run away from themselves. However much they think they can use forward guidance as coming back to what we started talking about, actually targeting future expectations. People are human beings with subjective concepts about what is value. Whether they want a good now or later, really, to me, determines the utility of money. If I want something now, I'm prepared to pay up for it. I will pay a greater interest for it. Whereas if I don't want it for some time, then obviously there's a lower rate of interest there. There cannot be a state edict in the sort of issuance of money. This is the battle that's going on. Are central banks, who very much have the upper hand, are they going to be around in 5 to 10 years in the format they are? Are they going to be elected officials, because obviously not democratically elected? Will a new regime come into place of the like that you and I have discussed, whether it be free banking or free banking, maybe even backed with gold, or will the state invoke a gold standard, which could be that could solve their problems to the extent of for another 20, 30 years until they start printing against that.
Well, I think these are all questions for the future. But Ben, I'm very, very grateful for you taking so much time out to talk to us. And I'd just like to say again that for our listeners who want to find out a bit more about Hind Capital, it's www.hindcapital.com. Ben, thank you very much indeed.
Subscribe to the Gold Money newsletter at www.goldmoney.com to receive email updates on new articles, videos, and iTunes podcasts from our Gold Research section.